When trading continuation days, we look into the previous daily candle to set an invalidation point. And there's only two different ways you need to know how to do this. The first is when we look into the previous daily candle, when we expect the following to be a continuation, is when it has a large opposing wick and that closing price is near the open on that daily candle. This is an example on the left for a bullish example. There is a large lower wick, so it's larger than the rest of that candle body. And then we have a close near the open. That means I'm going to take the low of that wick to the high of that wick, draw that out, and then 50%, or what we consider equilibrium, is that invalidation point. So this following day, we don't want to see that lower wick go beyond 50% of the previous day's wick. Everything should occur above that level. We should get that intraday reversal above, and then we can trade that to the upside. The same goes for a bearish example. We have a large upper wick. We expect the following day to be a continuation to the downside. We have a close near that opening price. So I'm going to take the high of that wick to the low of that wick, draw that out. 50% or equilibrium of that wick is the invalidation point. On the open of this next daily candle, when we expect it to be a continuation, it should not go beyond equilibrium of the previous day wick. That's where that intraday reversal should take place, anywhere below that point. The second type, again, when we're already expecting that following day to be a continuation, if the previous daily candle was an expansion daily candle, so if you notice, there's not a large wick here, there's a small wick, a large candle body, a large range candle. It's that expansion candle, which we mentioned earlier in the course. That would be when you mark out the low to high of that previous day range, and we get equilibrium of that point. That means the following day, for this bullish example here, we would not want to see it go below that invalidation point or 50% of the previous day's range. The same thing goes when we look at a bearish example. We'd be expecting that continuation lower on the following day. We look into the previous day. It's a large candle body, an expansion daily candle to the downside. I'm going to take the high to low of that previous daily candle's range. Equilibrium or 50% is that invalidation point. So the following day, we don't want to see that wick being formed through that point. It should be formed below, and that would be where it's valid. After defining these 2 points on the daily candles, you have the option to refine it down on an hourly time frame. So this would be an example of the previous daily candle. We're expecting a continuation to the upside. The previous daily candle was an expansion, viewing this on an hourly time frame. We could refine that down looking above 50%, because again, on the daily candle, we want to see the market remain above that in the following day, expecting the continuation. If we're looking for opposing candles above that point, we could use that as a refined invalidation. Since this low should not be traded back to anyways, we have opposing candles above 50% of previous day's range. Then we can mark this out from the high of that body to the low of that body, marking that out. That would be your refined invalidation point. It's just like in the price signature section when you're using higher time frame framework for opposing closed candles, you would use 50% as your invalidation point. And while this example shows one where the previous day was an expansion candle, this applies in the same way if the previous day had a large opposing wick. And at this point, you may be asking yourself, why do we even do this? And the reason behind setting the invalidation points in this way is when we're already expecting that continuation in an expansion candle, just like I mentioned earlier in this course, expansion days have small opposing wicks. Bullish expansion days open near the low, close to the highs. Bearish expansion daily candles open near the highs and close near the lows, and they don't make those deep opposing runs before expanding in the other direction. This invalidation point in this way demands that signature and forces it on the market. On either example, if the previous day was an expansion candle or had a large opposing wick, if from that day that you were expecting the continuation, from the opening price, if it dropped below and through that invalidation point, it is showing that it has a large opposing wick. It's not making that shallow run anymore. It's making a deep run below the daily open when you were expecting that continuation higher. Of course, this is a bullish example, but it shows that it's creating a large wick, and that is not favorable for an expansion, so we consider it an invalidation.